I'm going to talk about where the public finances stand today, how they're set to evolve over the next few years, and what the main risks are to that path for the public finances over the longer term. So firstly, where do the public finances stand today? Well, last year, in 2017-18, borrowing was about £40 billion. That's pretty much in line with the deficits that we were running before the financial crisis, and much lower than the very large deficits that we were running during the financial crisis. Now, as a share of national income, it's actually somewhat lower than those pre-crisis levels at 1.9% of national income. Significantly, this is actually lower than the average deficit that was run between the Second World War and the financial crisis. And what that means is that we're now back to normal levels of the deficit, having come a very long way since 2008. And this is not what subsequent successive OBR forecasts have expected since November 2016. They've expected borrowing this year to be somewhat higher. So even back in March, borrowing for 2017-18 was set to be £5 billion higher than the latest outturn. Forecasts since November 2016 expected it to be much higher, at almost £60 billion. And in fact, the latest outturn looks pretty much in line with the forecast for that year back in March 2016. And what that means is that the public finance data so far are actually yet to reflect any worsening of the outlook since June 2016 in the referendum. But it's also important to note that this isn't largely because subsequent forecasts have been too pessimistic on the economy. In fact, the economy has grown more slowly than the March 2016 forecast suggested, as Christian has shown. But instead, other factors have moved in the right direction for the public finances, and that means that borrowing now is just at £40 billion. So borrowing back to those pre-crisis norms, but based on the latest government plans, as set out in the spring statement, borrowing was set to fall further over the next few years. Now, it's important to emphasise that these plans are contingent on delivering some pretty tight spending settlements and further welfare cuts still working their way through the system. And Ben's going to talk about those in more detail in a moment. But assuming that those plans were delivered, then in 2022-23, the deficit was set to be at just 0.9% of national income. We've run a deficit lower than that only 6 years of the last 40. So this would really be a tight fiscal position relative to recent UK history. Despite that, the government still wants to go further. Its fiscal objective requires eliminating the deficit entirely by the mid-2020s. So even if those tight spending plans are delivered up to 2022, then on these forecasts there would still be further consolidation required to the tune of about £20 billion if that target were to be met. So that will require a lot of difficult decisions for the Chancellor, both on spending and on tax. He might hope that in the same way that forecasts have proved to be too pessimistic in the past, that this forecast will also prove to be too pessimistic. If other factors were to improve the public finances, that would allow him to spend more without having to increase the deficit above spring statement levels. So I've already shown you that the 2017-18 outturn was lower than what was forecast back in March. And actually, based on data so far this year, it looks like the public finances might undershoot that forecast again. So we think that based on strong receipts data so far this year, that borrowing might be expected to come in at around £32 billion rather than the £37 billion that the OBR was forecasting back in March. If that were to persist over the forecast horizon, and taking into account revised paths for equity prices and interest rates, then the Chancellor might be looking at a forecast improvement before policy changes of about £6 billion at the end of the forecast in 2022. Now, that would be a welcome £6 billion for the Chancellor. It might make things a little bit easier. I think it's important to emphasise just how small a revision of £6 billion is relative to the total amount of uncertainty in any public finance forecast. And there are reasons to believe that this public finance forecast is going to be more uncertain than most. So really that £6 billion is a very modest revision indeed. And even if that were to materialise, it would still leave a deficit of £15 billion in 2022-23. So certainly this isn't the kind of improvement that would sort of make all of the Chancellor's trade-offs disappear. There would still be difficult decisions to come. So given how difficult those decisions seem to be, perhaps one attractive option might be not to reduce the deficit, to perhaps leave it at current levels. I've already told you that we're now back to pre-crisis norms. Of course, the main cost of running higher deficits is that means debt will be higher. And while the deficit is back to its pre-crisis level, debt, which is roughly the accumulation of all government borrowing done to date, is still much higher as a result of the very large deficits that were run during the financial crisis. So actually, debt as a share of national income is 50 percentage points higher now than it was in 2007. That's the highest level since the 1960s. We might hope that, therefore, that debt will be set to fall quite quickly over the next few years, that we'd be returning back to those pre-crisis levels. And actually, if you look at the profile here, it does look like debt is set to fall quite quickly over the next few years. But this is really artificial. It's driven by a Bank of England program. So the Bank of England have made some loans to private sector banks, and that fall in 2020 and 2021 reflects the anticipated repayment of those loans. So if we strip out the Bank of England here, then actually you'll see that debt is much higher than its pre-crisis levels, and it's hardly set to fall at all over the next few years. It's remaining stubbornly high at almost 80% of national income. Now, this is actually slightly surprising. I've told you that the deficit is set to be below average levels over the next few years. We're going to have some economic growth, and yet debt as a share of national income is hardly falling. So in 2022-23, the last year of the forecast, we're set to have a deficit of only 0.9% of national income, and yet debt is falling by only 0.3% of national income. For comparison, in 1990, when we ran a deficit of the same size, debt fell by 1.4% of national income. So this really is a sort of disconnect between a low deficit and yet debt falling only slowly. So what's going on here? Well, there are two parts to this story. The first is a denominator story. So the debt to GDP ratio is falling slowly, in part because GDP is set to grow only sluggishly over the next few years. On the latest OBR forecast, even in 2022-23, growth is set to be only 1.5%. That's relative to a pre-crisis average of 2.7%. And actually, the OBR is somewhat more pessimistic than other independent forecasters, expecting growth in 2022 of about 1.9%. And that's largely because the OBR has a relatively pessimistic view of productivity. And to give you a sense of how important this is in slowing that decline in debt to GDP, if growth were instead in line with that pre-crisis average of 2.7% over the next 4 years, then even if we ran the same level of deficits, so all of that extra revenue was spent in some way and deficits were still at the same level, debt will be 4% of national income lower. So that sluggish growth over the next few years is playing a big role in preventing debt as a share of national income falling. The second thing that's going on is somewhat more subtle. It concerns the way in which student loans are accounted for in the public finances. So we give loans out to students, and only around half of that is expected to be repaid. And that means that the student loan system is a net giveaway from the government to students. And yet, as it stands, this isn't reflected in the headline measure of the deficit. In 2022, student loan accounting actually reduces the deficit, and overall it flatters the headline borrowing measure by around £15 billion. And this is largely because the interest on outstanding loans is being scored as a receipt in the public finances. And that's despite the fact that much of that interest is not going to be repaid. So both of these factors, relatively sluggish growth compared with pre-crisis levels, and the fact that student loan accounting means that there's a lot of borrowing that's going on outside of the headline measure of the deficit, are set to persist into the longer term. So what does that mean about how quickly we can expect the debt to GDP ratio to fall over the next 50 years, say, and how does that depend on the deficit that the government chooses to run? Well, assuming that OBR long-run projections about growth are correct, so that has growth returning to about 2.2 or 2.3% per year, and assuming that the government were to not do any further deficit reduction from now, that would be one definition of ending austerity. Well, then on these projections, debt would fall as a share of national income, but only slowly. It would still be over 70% of national income, 70% of national income in 2040. If, on the other hand, the government eliminated the deficit entirely in 2023-24, So this would be meeting their fiscal objective with a couple of years to spare, and then maintain that forevermore, well then debt would fall more quickly, but it would still be over 50% of national income in 2040. Now these paths suggest that debt as a share of national income is going to follow a smooth path over the coming years, but of course we know that's unlikely to be the case. In particular, we know that recessions tend to be nasty fiscal surprises that lead to higher debt to GDP ratios. Now in the UK, we can expect a recession about once a decade based on recent history. And we're going to assume that when a recession comes along, it leads to the debt to GDP ratio increasing by about 10 percentage points. That would be a less severe recession than the one in the mid-2000s, late 2000s, and than the one in the early 90s. It would be a somewhat more severe fiscal effect than those in the 60s and 70s. So what would we expect to see for the debt to GDP ratio in this case? Well, even if the government ran no deficit in the good times, so in years outside of recessions, and if deficits occurred, as we assume, and had the impact we assume on the debt to GDP ratio, then even in 2066, debt would still be around 70% of national income. If, on the other hand, the government only endeavoured to run a budget as tight as the current level in good times and allow the deficit to increase during recessions, then actually this would leave debt on a rising and therefore unsustainable path over time. Now, one might object that one reason for running deficits might be in order to stimulate growth. For example, if you run a deficit and therefore can do public investment that leads to higher growth. But even if growth in good years were at 3.5% per year, so this would be outstripping even those pre-crisis levels of growth that we saw. Even then, if we run a deficit of 1.8% of national income in good times, we'd expect to see growth on a rising path over time. So to conclude, contrary to recent OBR forecasts, the deficit is now back to its pre-crisis level. However, there is more consolidation, more deficit reduction to come over the next few years. Some good news for the Chancellor is that a small downwards revision to borrowing before policy measures is likely in the budget. But this really is very modest relative to the amount of uncertainty surrounding any public finance forecast, let alone this one. While the deficit is back to pre-crisis levels, debt is still much higher, 50% of national income higher than it was in 2007, and it's set to fall only slowly. And given the likely impact of future recessions and the amount of borrowing that's going on outside of the headline deficit measure, there are good reasons to target a deficit below the current level, at least at some point in good times. I'm now going to hand over to Ben, who's going to talk in more detail about the trade-offs facing the Chancellor at the forthcoming spending review.